Index funds versus mutual funds. What's the difference? Beginner's Guide. Imagine you're finally ready to invest your money. You open your investment app, and suddenly you're faced with two popular options: index funds or mutual funds. At first glance, they look almost identical. Both let you invest in many companies at once. Both can help you grow your wealth. But here's the question: which one is actually better for beginners? In today's video, I'll break down the differences in the simplest way possible, compare their pros and cons, and help you decide which one deserves your hard-earned money. By the end of this video, you'll know exactly which option fits your investing goals. So hit that like button, subscribe to the channel, and let's get started. What is a mutual fund? Let's start with mutual funds. Think of a mutual fund as a large basket filled with many different investments. Instead of buying individual stocks one by one, you pool your money with thousands of other investors. A professional fund manager then decides which investments to buy and sell. Their goal is to outperform the market by carefully selecting investments. Sounds great, right? Well, professional management usually comes at a cost. Mutual funds often charge higher management fees because experts are actively making investment decisions. What is an index fund? Now let's talk about index funds. An index fund is also a basket of investments, but instead of trying to beat the market, it simply aims to match the performance of a specific market index. For example, if an index tracks the largest companies in a country, the index fund simply buys those same companies in similar proportions. There's no manager constantly trying to pick winners. The fund simply follows the market. Because of that, index funds usually have much lower fees. And over long periods, many index funds have performed very well by simply tracking the market. The biggest differences. So, what's the real difference? Management. Mutual funds are actively managed by professionals. Index funds are passively managed by following a market index. Fees. Active management costs money. That's why mutual funds often have higher fees. Index funds usually have lower expenses because they require less day-to-day management. Over many years, even small fee differences can have a noticeable impact on your investment returns. Performance. Many actively managed mutual funds aim to outperform the market. Some succeed, many don't. Index funds don't try to beat the market. They simply aim to match it. For many long-term investors, matching the market has proven to be a reliable strategy. Which one is less risky? Here's an important point. Neither investment is completely risk-free. Both can go up. Both can go down. The main difference is in the investment strategy. A mutual fund's performance depends partly on the decisions made by its manager. An index fund depends on how the overall market performs. Since both usually hold many different investments, they offer diversification, which helps reduce the risk of relying on a single company. Which one should beginners choose? If you're just getting started, an index fund is often an excellent choice. Why? Because it's simple, low cost, well diversified, and easy to understand. You don't have to worry about whether a fund manager is making the right decisions. You're simply investing in the broader market. That doesn't mean mutual funds are bad. Some have experienced managers and strong long-term records. But it's important to compare fees, investment goals, and performance before making a decision. Common beginner mistakes. Before you invest, avoid these common mistakes. Don't choose a fund based only on recent performance. Don't ignore the fees. Don't expect quick profits. And don't invest money you'll need in the near future. Successful investing isn't about finding the perfect fund. It's about staying consistent and thinking long-term. Final thoughts. Let's quickly recap. A mutual fund is actively managed by investment professionals. An index fund simply follows a market index. Mutual funds often charge higher fees because of active management. Index funds usually have lower fees and aim to match the market's performance. For many beginners, index funds offer a simple, affordable, and effective way to start investing. But whichever option you choose, remember this: the biggest mistake isn't choosing the wrong fund. It's never investing at all. Building wealth takes time, patience, and consistency. The sooner you start, the more time your money has to grow. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell for more videos about investing, personal finance, and building long-term wealth. Now, I'd love to hear from you. If you were starting your investment journey today, would you choose an index fund or a mutual fund, and why? Leave your answer in the comments below. Thanks for watching, and I'll see you in the next video.